we can see gold and the Dow being close to equal again. Well, unless you think the Dow is going to completely implode by 90% or more, the only way you can get to that kind of parity is if the gold price goes way up. So maybe the Dow can go down from, almost 40,000, where it is now, high 30s. But maybe you can go down to 20,000, which is not, outside the realm of possibility. And if gold were to go up to 20,000, there you go. 20,000 gold is almost a 10x increase from where it is now. That's not that much. I mean, gold was under 300 in 2000, and it was almost 2,000 in 2011. Gold can have very big gains. It's done it in the past.
PeterSchiff, an American stockbroker, suggests the possibility of gold and the Dow Jones Industrial Average nearing parity again, either through a significant decline in the Dow or a substantial increase in the price of gold. He proposes a scenario where the Dow could decline to around 20,000 while gold rises to $20,000 per ounce, representing a tenfold increase from its current price. On Monday, gold prices traded slightly softer, nearly $2,335, during the early Asian session. Recent U.S. economic data indicated firm inflationary pressures, casting doubts on near-term U.S. Federal Reserve rate cuts. The Federal Reserve's interest rate decision on Wednesday will be closely monitored. Schiff highlights the significant devaluation of the U.S. currency over time, stressing the loss of purchasing power since the establishment of the Federal Reserve in the early 20th century. Gold has long been viewed as a store of value and a hedge against inflation, with its purchasing power remaining relatively stable or increasing over long periods. Its scarcity and slow supply growth through mining help maintain its value over time, as demand often outpaces supply growth. Expressing concern about the U.S. fiscal situation, Schiff cites large deficits, debt-to-GDP ratios, and escalating interest payments on the national debt. He believes these factors could lead to a fiscal crisis and exacerbate inflationary pressures in the years ahead. The United States faces an imminent fiscal crisis unless it reduces its federal budget deficit to curb debt growth. With already high federal budget deficits set to increase further, the federal debt is projected to reach its highest ever level relative to GDP within 4 years. Come along as we explore PeterSchiff's valuable insights. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
If you think about where gold peaked in 1980 timeframe, it peaked at around the Dow equaling 1 ounce of gold. Gold got to 800 and the Dow got to 800. And that's about where the Dow bottomed in 1932 as well, when the Dow was down around 1 ounce of gold. So if you figure that we could make it a hat trick and we can see gold and the Dow being close to equal again, well, unless you think the Dow is going to completely implode by 90% or more, the only way you can get to that kind of parity is if the gold price goes way up. So maybe the Dow can go down from, almost 40,000, where it is now, high 30s. But maybe you can go down to 20,000, which is not, outside the realm of possibility. And if gold were to go up to 20,000, there you go. But 20,000 gold is almost a 10x increase from where it is now. But that's not that much. I mean, gold was under 300 in 2000, and it was almost 2,000 in 2011. So gold can have very big gains. It's done it in the past. And if you look at where gold is now in relationship to where it was when the Federal Reserve first came on the scene in 1916 or 1913, or is it, 16,
13.
with the income tax and the Federal Reserve, right? Or 1916.
I thought it was 13.
Or is it 13?
Yeah.
Yeah, all right. I mean, I something like, whether it's 1913 or 1916, gold was $20 an ounce at that time. So it's more than 100 times the price that it was back then. Looking at it the other way around, it means that U.S. currency has lost more than 99% of its value during that time period. The lion's share of that loss happened, since the 1960s, right? Because but I think it's going to really start to accelerate in the years ahead. I think, the amount of purchasing power the dollar is going to lose. We've just got a small taste of that with the spike in inflation over the last, few years. But this is just the beginning. I mean, it's not the end of it. Like the Fed claims, hey, it's all over. The worst is behind us. They said that in 1972, 1973, right? They thought inflation was over back then because it came down from 6.9% in 1969 to like 3.5% in 1971, 1972. So they thought that was it. And the next thing you know, it was double digits. And so I think we're in a much worse position now when it comes to how bad inflation is going to be, because we're in much worse fiscal shape than we were back in 1970. The amount of inflation in the pipeline is much greater. I mean, the deficit spending of the prior decade dwarfs what happened under LBJ during the 1960s, where you had Vietnam, the war on poverty, Great Society, going to the moon, all that stuff, guns and butter, budget deficits. That laid the foundation for the 1970s. Well, what's happened since the 2008 financial crisis with QE 1, 2, and 3, COVID, QE, all that, has laid the foundation for a much bigger inflationary explosion. And it's happening when the U.S. is in much worse shape. We have debt to GDP of 120%. We've got $1 trillion a year trade deficits as far as the eye can see, $2-3 trillion a year budget deficits. Not only as far as the eye can see, but as far as the eye can see, the deficits get much bigger than that and not that far out. You know, we're already spending over $1 trillion a year on interest on that debt. That's more than we spend on national defense. A year from now, it'll be $2 trillion. So interest on the debt will be greater than Social Security or Medicare. It'll be the number one line item in the federal budget. And then it'll keep rising from there. So clearly, a fiscal crisis is coming.
Recent data from the World Gold Council reveals a notable trend. Central banks have become significant buyers of gold. This shift towards hard assets reflects a broader movement amidst global financial uncertainty. In February, China further reduced its holdings of U.S. Treasuries by $22.7 billion, bringing its total holdings down to $775 billion, according to the latest figures from the Federal Reserve. PeterSchiff criticizes individuals who have sold their tangible gold assets to invest in cryptocurrencies like Bitcoin, referring to such actions as investing in fool's gold. Schiff underscores the strategic moves made by foreign central banks, particularly those in emerging markets, to diversify away from the U.S. dollar through substantial purchases of gold. Moreover, there are suspicions that China may possess more gold than it officially reports. Jim Rickards previously pointed out that many analysts believe China holds several thousand tons of gold off the books, within a separate entity called the State Administration for Foreign Exchange. Schiff warns that time may be running out for investors to enter the gold and silver markets before a potential surge in demand. This anticipated increase in demand is expected to be driven by heightened investor awareness and constrained supply within the gold mining industry. Let's get back to the interview.
Physical gold and silver still very cheap, especially silver, which is still under $30. You know, it got to $50 in 2011, which equaled the high in 1980. You know, and we've already seen explosions. Look what's happened to coffee prices. Look what's happened to cocoa prices. I mean, one by one, these commodities are going ballistic. And, you know, this is, again, a leading signal of higher inflation to come. But gold is just starting, you know, and I think silver is about to explode. So you can go to Schiff Gold, that's my gold and silver company, to get some physical precious metals. Everybody should have some savings in gold and silver. Very few Americans do. You know, the buyers have been in China. They've been in India. The Americans have been too dumb to buy. They've been buying, you know, Bitcoin or some other crypto. They've been selling their real gold to buy fool's gold. And the other big buyers have been foreign central banks, emerging market central banks in the East. That's who's been buying gold. You think these guys are dumb? No, they know what they're doing. They can see the dollar's demise coming because they're part of it. They're part of the de-dollarization process. They want to get rid of dollars, but they have to buy something with their dollars to get rid of them. They're buying gold, but they're not buying the euro. They're not buying the yen. They're buying real money, right? They don't want another fiat currency trying to back up their currency. They want real money. And so the process has started. You know, so you can either, get crushed by it, or you can, take part in it. But there's not that much more time, I think, to really put the trade on, because I think once Wall Street wakes up from this sleep and more people recognize what's going to happen, it's just going to be a mad dash to buy these stocks, and just the prices are just going to go straight up because there's just not the supply. You know, it's such a tiny little sector, gold mining. I mean, the whole market cap of the entire industry worldwide, I don't even know if that would make it into the, the top, 50 companies in the S&P. I was joking, one day Nvidia's, its gain in one day more than exceeded the entire gold mining industry combined.
Wow.
So not the market cap, just the increase in the market cap in a single day. So that gives you an idea of what you're dealing with. And if you've got, in pension funds, endowments, hedge funds, retail investors, all of a sudden taking an interest in a sector they've had no interest in, for 10, 20 years, just imagine what's going to happen to the price.
JP Morgan reaffirmed gold's structural bull case on Thursday, maintaining a peak target of $2,600 per ounce. What are your thoughts on central banks' increasing acquisition of gold? How might this trend impact global financial dynamics, particularly in the context of geopolitical tensions and economic uncertainties? Share your perspective in the comments below. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.